Hello and welcome to Between the Lines, the podcast that dives deep into the stories reshaping Asia Pacific's reinsurance landscape. We're recording here in the Hong Kong newsroom of InsuranceAsia News. I'm Mithun Varkey, Editor-in-Chief. In this episode, we'll bring you up to speed on the biggest stories of the past week and give you a sneak peek into the stories we're working on. Also, we've got a special guest with us this week, George Lewin-Smith, the CEO and co-founder of US-based startup Testudo, a Lloyd's cover holder that specializes in something we're all trying to figure out right now, generative AI risk. We hear a lot about how fast AI is being adopted by businesses. But the risks, they don't get the same attention. Today, George breaks it all down, the key risks companies face when adopting AI, and the options business owners and risk managers have to protect themselves.
And so a number of inbounds we get are from normal Main Street America companies using generative AI, asking their broker, hey, are we covered for our use? And the insurer saying, what? Well, first of all, what is generative AI? Second of all, I didn't have a clue that you were using it. And third of all, there is a significant exposure that we don't want to cover or price. And so that's what we see a lot of in the market. And I think the silence is also not good enough for sophisticated enterprises. They need to know that through their use, they are covered.
Joining me today is the full editorial team of InsuranceAsia News. I have with me Deputy Editor Andrew Mullen, Senior Correspondent Aidan Gregory, and reporters Joana, Nguyen, and Roshan Nambiar. Welcome, everyone.
Hi, Mithun. Hi, everyone.
Great, let's get started. Global reinsurers have been reporting their first quarter results these past few days, giving us updates on the April 1 renewals as well. It's no surprise that the big reinsurers have been reporting stellar results, like we've seen over the past several quarters. A benign NatCat environment has helped companies deliver, in many cases, record results. But it's not just about the numbers. Especially the big three reinsurers' results give us a fascinating look into what's happening with April 1 renewals and how carriers are reacting to softening markets. Aidan, can you break it down for us?
Sure. So we're right in the middle of first quarter earnings season at the moment, and there's definitely an interesting picture emerging, particularly among the major reinsurers. The results so far, show an industry that's in very good health. And as you say, Mithun, the top reinsurers have had a relatively easy ride over the last 12 months in terms of the volume of natural catastrophe losses, with the exception of the LA wildfires, which was booked in the first quarter of last year. So many of the quarterly results do show this kind of very, very big swing upwards in terms of profitability. But that is partly because of the LA wildfires. But the first quarter of 2026 was highly profitable for Munich Re, Swiss Re, and Hanover Re, unlike the first quarter of 2025. For example, Munich Re's P&C reinsurance division put up a combined ratio of 66.8% in the first quarter of 2026, compared with 83.9% during the same quarter last year. Swiss Re also had a good quarter with a combined ratio of 79.5% in P&C reinsurance, while Hanover Re was 83.6%. So there's very strong profitability. But a clear picture is beginning to emerge that the major reinsurers have been pruning their books during the recent 1/4 renewals in Asia Pacific amid the ongoing global reinsurance market softening. Munich Re has really led the way with this. It cut its book by 18.5% at 1/4 renewals, while Swiss Re last week said that it cut its P&C treaty reinsurance volume by 8%. Hanover Re here is very much a bit of an outlier. It actually grew its premium by 18.8% during the 1/4 renewals. Rates are falling, and the reinsurers are adjusting their portfolios to the market conditions. Munich Re's CFO, Andrew Buchanan, did sound off a few notes of caution on the reinsurers' earnings call yesterday. Despite the healthy picture, Munich Re's CFO, Andrew Buchanan, did sound off a few notes of caution on the reinsurers' earnings call yesterday. Firstly, he acknowledged that Munich Re's reinsurance revenue goals would be harder to achieve amid the market softening, although he said he was optimistic about the deal-making opportunities that lie ahead for Munich Re in life and health and P&C. And the German reinsurer has reaffirmed its 2026 financial targets, so they're very much on track to hit those targets. Buchanan also warned about the inflationary impact of the war with Iran in the Middle East, which has caused energy prices to spike. Munich Re's claims arising from the conflict have been relatively light at 90 million euros so far, but Buchanan warned that the industry needs to keep a close eye on the ripple effects of increased inflation and what that means for investment markets and for claims costs. Anybody that's recently booked a flight or filled up at the petrol pump can certainly attest to the pretty intense spike in inflation that's currently happening at the moment, and that will have pretty material consequences for the reinsurers, as it does have a major impact on the cost of claims and also the capital markets and the investment income that the reinsurers derive from capital markets.
Yeah, and Aidan, as you mentioned, the industry is in very good health, and this was underlined by a report from Gallagher Re this week, which showed the reinsurance industry enjoyed a landmark year in 2025. Global total reinsurance dedicated capital reached a new high of $648 billion last year, representing an 11% increase from 2024, and this was the strongest year for capital growth in over a decade. This growth was driven by retained earnings in traditional reinsurance capital and historic inflows into non-life alternative capital. The industry also achieved record profitability and capital growth in 2025. That's according to Gallagher's report. Gallagher Re's reinsurance composite, which tracks the performance of leading reinsurers, reported a 19.3% ROE for 2025, supported by strong underlying profitability and benign nat cat losses, which you've already mentioned. This represented one of the highest ROEs recorded since the inception of the market report.
Thanks, Andrew. Thanks, Aidan. Yeah, I mean, retained earnings, going by the Q1 results, there's more money and capital coming into the reinsurance market. Moving on from the results, one of the more exciting developments in the Asian reinsurance space in recent weeks was about news about Willis Re. Last year, WTW rebooted the Willis Re brand, which it had retired after the sale of its reinsurance broking business to Gallagher, which then got rebranded as Gallagher Re. But last year, in a joint venture with Bain Capital, they relaunched Willis Re. And there's been a lot of buzz around Willis Re since then. We've been hearing that they were eyeing a late 2026 entry into APAC. But then on April 30, they announced the appointment of Richard Jones to lead Asian operations. Jones will start in this new role in October. Richard Jones is a very well-known name in the reinsurance broking market. He joins Willis Re from Gallagher Re, where he was most recently Asia chairman. He was only promoted to that role in February this year. Jones has also previously held leadership roles at Aon Re and Guy Carpenter in Asia Pacific. What's really interesting is that Willis Re's entry into Asia Pacific just turns up the heat on the broker competition in the region that has so far been largely controlled by the big three, which is Aon Re, Guy Carp, and Gallagher Re. This comes even as Howden Re which has been making some inroads into the market lately, including, as I understand, placing their first treaty business from Japan this year. So certainly there's the incumbents, Aon Re, Guy Carp, and Gallagher Re. Howden Re, which is making some headway. Willis Re joining the race makes it very competitive. So we're looking at a coming war, obviously a war for business, and even more so a war for talent. In fact, Willis Re has already been hit with a lawsuit in London for poaching 22 employees from Guy Carpenter. And in APAC, could Willis Re try to lift entire teams from their rivals? And if they do, could that lead to more lawsuits? I think that's something that we'll be actively keeping an eye out for. Another big people move from the region, the Ardena Group has hired Aon Southeast Asia head Andrew Mullen as CEO for its Asia business. Ardena has been making big inroads into Asia, making massive investments. Mullen will spearhead the company's business across Asia, working with teams in Singapore and Hong Kong. Mullen is also expected to take on the role of CEO for Price Forbes Singapore, which is Ardena Group's primary vehicle in Asia Pacific.
This week also saw a big move within Howden's Asia operations. From July, Alaric Lee is stepping into the role of Chief Executive Officer at Howden Hong Kong, succeeding Alfred Sham, who is relocating to Singapore to take on a new role of Chief Strategy Officer for the Asia region.
Moving on from People Move, we've also had some big M&A announcements recently. Roshan, can you give us a quick recap?
In the last couple of weeks, there's been a couple of big M&A moves. So for the first one would be the private equity firm Hillhouse Investment acquiring Mercer's Private Client Services, or as in short, or PCS, which is Marsh's high network wealth and life insurance brokerage business. We had reported Marsh weighing the sale back in February, and when Marsh said that the sale was a part of their plan to streamline their entire global portfolio. So Mercer Private Client Services provides financial risk management and life insurance services to more than 8,000 clients across roughly 50 markets, including in Asia and places like Singapore, Hong Kong, Shanghai, Geneva, and elsewhere, including Geneva and Zurich. Another big one is the BP Marsh-backed Australian underwriting agency ATC Insurance Solutions, who acquired Frontier Global Underwriting, a specialty financial lines MGA and London market wholesale broking group. Frontier writes a diversified portfolio across emerging markets, financial institutions, and Australian retail and wholesale financial lines, as well as cyber, crime, D&O, professional indemnity, and specialist digital asset risk. ATC, when they announced this, said that the acquisition marks a significant strategic expansion and it enhances its international underwriting capabilities, and it also deepens its presence in financial lines, emerging markets, as well as in the Asia Pacific region. And for just a brief background into BP Marsh's involvement, they hold a 25% stake in ATC.
Yeah, that's quite an interesting deal from BP Marsh there. Frontier Global, it's a well-known MGA led by Joel Pridmore, who's been our guest in one of our podcasts previously. The other big deal was from Malaysia. Roshan, what's that about?
Malaysia's RHB Bank, they received approval from Bank Negara Malaysia, or BNM, to begin talks with Tokio Marine Asia on a potential sale and merger of its general insurance arm, RHB Insurance, with Tokio Marine Insurance, which is their Malaysian branch of Tokio Marine. RHBs could retain up to a 35% stake in the combined company, and the parties have 6 months from May 11th to finalize these negotiations. I mean, they had previously had an attempt which fell through, and as well as that, RHB also renewed its 20-year bank assurance and Bank Ataka full partnership with Tokio Marine Life. And to continue on with Malaysia, there was actually one more, which was VRS, the global loss adjuster, who entered a partnership with Malaysia-based Century Independent Loss Adjusters. Century Independent Loss Adjusters they provide claims management services across motor and non-motor lines, and have a team of over 150 professionals, a call center, and around 10 branches across Malaysia.
Thanks, Roshan. It's busy deal-making season, it seems like. Joana, last week, Swiss Re Institute released their Asia NatCat report. What are the key insights from the report?
Right. So based on that report, insured losses from natural catastrophe in Asia totaled $5.2 billion in 2025. This is well below the prior 10-year average and the lowest since 2017. Main drivers included earthquakes, floods, and tropical cyclones, with each causing insured losses at least $1 billion. Earthquakes in particular led to $1.9 billion in insured losses, mainly because of the quake in Myanmar in March last year. While NatCat insured losses in Asia accounted for only 5% of global insured losses, its total economic losses, which was about $65 billion, contributed 30% to the global figure, flagging a still sizable protection gap in the region. Swiss Re added that last year's catastrophe activity mainly concentrated in the emerging markets, as some of the largest, loss-making events struck lower-income countries with low insurance penetration and weak risk preparedness. So that was a very unfortunate reality.
Thanks, Joanna. It's indeed concerning that most of the events that last year were in the lower-income countries. But of course, one of the biggest NatCat exposed region in Asia Pacific is obviously Australia. They've also had some numbers recently, especially from the ARPC. Andrew, you've been across that. Can you give us the details?
So yeah, some new numbers regarding Australian cyclone pool from the Australian Reinsurance Pool Corporation. The cyclone pool has now expanded to cover over 3.2 million properties, with total claims since it started in July 2022 now exceeding 1.4 billion Australian dollars, which is about $1 billion US dollars. Its latest quarterly report, which runs up to December, which came out last week, shows that over 3 million homes, 73,000 strata buildings, and over 100,000 small business premises are now covered. In another release this week, the RPC also confirmed the cyclone pool has received over 126,000 claims since it started. Australia's recorded around 267 million Australian dollars, around 193 million US dollars, and insured losses from the cyclone declared events in 2025-2026. This has included 9 cyclone events, which have contributed to losses this season. Top of those is FINA, which is estimated ultimate loss of $60 million US. Now, it should be noted that the events of the current cyclone season aren't in the bigger picture because they haven't come through, and that includes Tropical Cyclone Umbrella, which actually came in 2 parts, and they made it clear that the numbers for that haven't came through yet. So we're going to be watching that space to see the impact of the recent cyclones on the pool itself.
Thanks, Andrew. I just want to bring back Joana. In the recent few days, there's been some escalation in the Middle East conflict. Joana, you've been speaking to brokers and underwriters. What's the latest you're hearing from the market?
Yes, I spoke to global broker Marsh recently, and they say that they're seeing and also expect to see 4 main types of claims that are coming. First is physical damage under hull and machinery war due to hostile acts. Second is cargo losses driven by delay, deviation, and congestion. Third is loss of hire from extended waiting and rerouting. And fourth one is P&I exposures in case an incident escalates into collision, injury, or pollution. And since the start of the conflict, rates have increased, significantly, as we all know. And Marsh say that at one point the rate has gone up to 7.5% of vessel value to transit in the Strait of Hormuz. And the key driver is not only the likelihood of an incident, but the concentration of high-value vessels and cargo in a narrow corridor, which is forcing much tighter aggregate management. And underwriters are recalibrating pricing and capacity in near real time, and quotes are holding for much shorter periods than normal. And overall, the situation remains extremely unpredictable, and the risk to shipping remains critical. We have seen several false starts over the past 2 months when it seemed that the risk to vessels have reduced because of diplomatic improvements. Some vessels were able to transit the straits under these conditions, but in each case, the situation worsened rapidly. Ships were also damaged or turned back as a result. So everything remains very volatile with lots of uncertainty at the moment.
Thanks, Joana. And we've seen India launch its maritime pool yesterday, which is Tuesday, and they've also issued their first war risk policies. What's also interesting in this context is that a recent interview with Ajit Jain, who's the vice chairman of Berkshire Hathaway, he said that they have taken a share of the U.S. U.S. reinsurance pool, which is run by Chubb. But what really stood out from his comment was that he said, we will participate in insuring ships in the Strait of Hormuz if they can get their terms in terms of the underwriting decisions, and if they can ensure that the U.S. Navy will escort those ships. I think there is capacity, there is all of that, but I don't think underwriters are still 100% comfortable with what's going on in that market. Great. So let's talk about all the stories that we're working on now. Aidan, what are you working on?
So after the Insurance Authority event the other week, the focus has turned to sort of what's next for the ILS regime in Hong Kong. And the thing on everyone's kind of minds and wish lists is a framework to facilitate the structuring of sidecars locally here in Hong Kong. And the Insurance Authority, based on our reporting from that event, is working on a framework. And this is something which the reinsurance industry in Hong Kong is really keen to see. Everyone that we've spoken to so far is really excited about the prospect of being able to marry reinsurance risk up with the significant amounts of private capital that sit here in Hong Kong. So that should be an interesting story.
Yeah, sure. I mean, that's the next step for the ILS regime in the region. There's certainly interest from reinsurers for sidecars. Thanks, Aidan. Joana, what are you working on?
So since the outbreak of the Iran war, lots of attention has been on marine insurance, but there's also a business line that can be heavily affected, and that is trade credit insurance. Heightened geopolitical instability increases the likelihood of business disruption, delayed payments, and insolvencies, particularly in sectors exposed to regional trade and energy markets. So I plan to reach out to trade credit insurers and brokers to see how they are navigating the situation.
Thanks, Joana. I will look forward to that story. Roshan, what have you got?
Earlier this year, I actually, as you must remember, I wrote a story about the data center market where I'd spoken about the boom of data centers stretching traditional underwriting limits, intensifying aggregation concerns, and pushing insurers, brokers, and investors towards a more specialized engineering insight, maybe even that's spoken about alternative capital and bespoke risk transfer structures. Since then, we've actually had a lot of coverage about data centers, where you actually recently also spoke to Terrence Williams of Aon about this. I thought actually it would be great to continue on this and follow up and get more responses from other players in the industry, where so far I've gotten some responses from FM and Marsh, where they also actually largely echoed the same statements that were in the earlier article. But I thought it would be great to combine some of this with some of the existing data and information available, some of the reports that we've covered in the past, to create a larger long-form report on this topic, since it's been a very popular topic and it will continue to be a major talking point in the industry.
Thank you, Roshan. Sure, yeah. I mean, as they call it, it's a once-in-a-lifetime opportunity for the insurance industry. So it's certainly worth digging deeper into. There's a lot going on, a lot to work on. It's a fantastic meeting. Thank you, everyone. Let's get back to work. Our guest this week is George Lewin-Smith, the founder and chief executive of US-based underwriting startup Testudo. A Lloyd's cover holder, Testudo is also an alumni of Lloyd's Lab, the platform's accelerator program. Testudo uses new data and technology to provide a unique view of AI litigation risk and has built a new liability product and pricing models for AI risk. In our conversation, George takes us inside the emerging world of AI risks. He shares some sharp insights on what exposure actually looks like for business owners and risk managers. And he lays out the full landscape of specialized AI insurance, what's out there, what's missing, and where things are headed. You won't want to miss this one. George, welcome to Between the Lines, and thank you for joining us. To kick off, could you tell us a little bit about yourself and how you came about setting up Testudo?
Well, brilliant to be here, and thank you so much for having me. Very excited to be talking about AI liability insurance to the Asian markets. It was my original home, having been born there, and I'm happy to give a bit of a background into myself and how I got into the insurance market. So my background was previously in capital markets at Goldman Sachs. I worked there for a number of years in San Francisco and originally in London. Before London, I was in a number of startups before teaching myself to code after graduating from Oxford University. But I saw firsthand at these major enterprises how difficult it is to deploy new types of technology. And as generative AI became the most important focus for the executives and the business at enterprises like Goldman, it became clearer and clearer that general counsels, risk managers, CFOs were concerned about their exposure to this new technology that they were deploying and the liability that those companies faced as a consequence of using the technology. And so as I saw Goldman looking to use nearly 400 different AI projects and put them into production, it became clear that there was no specialty insurance product that we could buy to transfer the risk of using this new technology into the insurance market in an easy way. And ultimately, firms like Goldman buy insurance for a whole range of specialty risks, whether it's cyber, whether it's D&O, whether it's tech, and for some reason there didn't exist an AI insurance product. My instinct was that if Goldman was struggling with this risk, so would everyone else in the market. And so I believe that there needs to be a new category of generative AI insurance products for enterprises deploying AI.
So how did you start Testudo? Was that what were the beginnings of Testudo?
Yeah. So I met my co-founder a few years previously. He had been working on the crypto insurance side, bringing specialty Lloyd's capacity to new types of risk. He has over 15 years of domain experience, not only as an underwriter and as a broker in the London, UK markets, but he and I basically started talking about what it meant for a generative AI insurance product and what that could look like for the economy. Ultimately, our vision is bigger than just generative AI. We believe that AI agents, autonomous cars, data centers, AI and robotics are all going to need a risk transfer layer and market globally. And in order for AI technology to scale and be deployed, there has to be appropriate liability exposure and risk transfer tools in place. Insurance is a traditional, old, and well-known and well-trusted one. And so we thought if we could bring, A+ superior rated Lloyd's capacity to an enterprise to cover their AI risk, they would be unlocked in their adoption of that technology, and they could sleep easy at night knowing that their exposure would be covered if they suffered any litigation. The other thing we saw was that litigation was massively increasing. The number of Gen AI specific lawsuits in the US is increasing at hundreds of % a year. And so when we started to look at the data on the AI lawsuits, we saw that obviously there was liability exposure, the litigation was increasing, and we knew that the number of deployments was also increasing. And so you had this perfect storm of increased litigation, increased deployments. And then the other thing we saw, on the 1st of January of this year was exclusions in certain lines of insurance. In the US, on the general liability side, ISO have introduced bodily injury and property damage exclusions for the GL policy as of the 1st of January. And so that creates a carve out and a need for a specialty standalone coverage product, which we provide affirmatively. And this was exactly how the cyber insurance market started. An exclusion out of GL, creating a coverage gap, which needed to be filled with a specialist standalone product.
That's quite interesting. You're talking about AI risks, and you've seen, companies trying to buy AI insurance.
Yeah.
What are the AI risks that we're talking about here? What sort of specific liability risks are emerging from the AI deployments?
So we've already mentioned bodily injury and property damage from the use of an AI system. And I think that's well understood, whether it's a chatbot in healthcare or you're deploying AI in a factory setting. But the other key risks that we're really focused on are obviously IP infringement risk. We see AI systems essentially as defective on deployment. That means that because they were trained on copyrighted material, that as you deploy and use that technology into your business, you are creating unintentional exposure for you. And so if you're creating marketing content or you're creating some wording, documentation or coding or whatever it is, you are basically exposing yourself to IP infringement risk, which is another one of our coverage areas. Another area that we're really focused on is unauthorized data disclosure. AI systems are not 100% accurate, they're probabilistic, and there are many examples of these AI systems giving out or up information sensitive or regulated to other third parties, which creates a liability exposure. We know this is especially relevant when it comes to regulated industries, especially healthcare, especially law firms, giving up sensitive professional or personal information about someone's health records or their sexuality or confidential compensation documents is something that's happening. And so we cover unauthorized data disclosure as well. One of the other areas that we cover as another high area of risk is something that we call AI output errors. And so these are hallucinations from these AI systems where these systems might negligently misrepresent to an end customer, resulting in a financial loss. And so that is another clear example. People always talk about Air Canada, where a chatbot negligently misrepresents, resulting in a financial loss to a customer. If you deploy the technology, you're responsible for it. And so that is another exposure that we are able to transfer with our insurance solution.
There's a few different areas of risk from AI. What's the biggest source of AI-related financial loss for businesses? What are the trends showing?
Yeah, so our data shows obviously there's significant copyright and IP infringement, patent infringement, there's some discrimination, and ultimately the trends are still early, so it's difficult to pull out like very specific insights for you on the spot. But I think that the end result of it is that the litigation is increasing. There are now 20 plus insurers in the US on the general liability side, excluding Gen AI from their casualty policies. And more broadly, we're seeing E&O exclusions well now for regulated firms like law firms. And that's exactly why we've got the coverage and designed the coverage that we have. It bakes into your casualty or your E&O or your professional line solution, and it's modular. So it just plugs in to an exposure gap.
So, people are buying AI cover as a top-up on their liability policy. Where does this sit, and how does that sort of operate in real world?
So this is a standalone product, and obviously people buy cyber, they buy GL, they buy a whole range of products. We exclude cyber in our policy, and we have no intention of picking up cyber liability in our solution. We think cyber risk is a completely different type of risk, and thus it's excluded on our product. as other buyers buy new types of products as well, whether they have a combination of tech or they don't hold tech where we see a lot of success is, a law firm, for example, is not selling a technology product or service, but they might be using generative AI. They don't hold tech and so our solution can come in and cover them for the outputs of the AI system, which might be wrong. And that's where we see a lot of success.
I mean, this is still early days for AI and Gen AI deployments. You mentioned litigation. You're seeing a lot of litigation. How well established is the legal environment for AI risks? I mean, do we have judgments and rulings that we can rely on, or is it still something that's very much evolving?
It's definitely evolving, and I think the US is the most advanced in this market, obviously being highly litigious, and also the courts and federal courts being open to transparent review. I think in the UK, there are maybe 3 to 5 Gen AI lawsuits. In Germany, a few. Asia, Australia, a few as well. And I think in Australia, there's also a few. So I think Asia is I'm sure there's plenty of legal action going on. I'm not as focused on that market yet because I think it's not quite as litigious as the US one, and the data is harder to see there. But I'm sure that deployments of AI are increasing, and I'm sure also that people are worried about their exposure from deploying the risk, and it's certainly going to be a big market for us in the future.
There is a lot of talk about silent AI. Some of the existing policies, already cover some of these risks, especially on cyber and tech. You're mentioning that there are exclusions coming in, but still quite a lot of the policies out there in effect do not yet have exclusions.
I think a few things I would mention on that. So on the cyber side, some people are now starting to say that they're covering AI deepfakes, or basically what they're doing is they are sublimiting those products through an endorsement. And the brokers actually really don't like that because, you might say now, okay, I've got a $5 million cyber policy, but I'm going to offer a $50K affirmative AI coverage. And so that removes the silence, but actually it's sublimiting the product massively. And so many brokers actually really don't like that. And when we speak to others as well about silence as well, when brokers go and ask the insurers, is my company or customer covered? The answer typically is, well, first of all, we didn't know that they were using AI. And second of all, absolutely not. And so a number of inbounds we get are from, normal Main Street America companies using generative AI, asking their broker, hey, are we covered for our use? And the insurer saying, what? Well, first of all, what is generative AI? Second of all, I didn't have a clue that you were using it. And third of all, there is a significant exposure that we don't want to cover or price. And so that's what we see a lot of in the market. And I think the silence is also not good enough for sophisticated enterprises. They need to know that through their use, they are covered, as they know that they've got the exposure. We've done the legal analysis on the terms and conditions and the vendor contracts. They push the responsibility of the outputs and the liability of the outputs onto the deployer. And so if that is the case, enterprises need to know that they are responsible for the outputs. And if that's the case, they should be happy with it sitting on their balance sheet silently or transferring the exposure with our insurance product.
What's been the feedback from the market, especially the insureds? I mean, for example, cyber, it took more than a decade for cyber to become, in any meaningful way, a mainstream insurance product. Is there demand in the market? Are you getting queries from the market, from brokers?
So we're taking tens and tens of submissions now, which is great from the brokers. I think it is early, and a key part of what we are doing is education. And we are investing very deeply and heavily in materials and webinars for brokers to really help them get up the chain. I think the speed of AI deployment is faster than anything anyone's ever seen before. And so I'm not anticipating the AI insurance market to take as long as cyber did. As this technology gets more widely deployed, and as it is, I think that's when we're going to start seeing more and more traction. Obviously, massive claims are going to drive adoption of this type of policy and solution, and that will also drive the exclusions, which we can cover. So I think there are a number of market dynamics and forces at play, but ultimately people are awake to the risks today, and they want to be able to represent to their board, if you're a chief risk officer or CFO or general counsel, that we are deploying this technology. We've tried to do a technical analysis of all the risks, and as a financial backstop, we've also bought this insurance, which gives us a sleep easy coverage to know that if it does go wrong, we're covered. if you're not having those conversations as a risk manager, I don't think you're fulfilling your fiduciary responsibilities. And if your insurance is silent, you should be determining very quickly whether you have that coverage for your deployments, and if not, buying affirmative.
Right now, where's the market? I mean, is it the big, large multinational, very sophisticated end of the market that's buying?
I would say at this early stage, there isn't a clear trend. We see everything from small startups to internationally systemic banks to major law firms to fitness centers. So I would say that it's too early to tell a specific trend, but the reality is, and what we're expecting, more companies are using AI than we were expecting, and more companies are interested in the product than we were expecting as well. So although it is early, we think this is going to become a more and more significant tool in a risk manager's belt, and obviously a basic part of AI governance.
So you've already started binding policies. Have you started seeing claims yet? Has there been any claims?
No claims yet.
That's a good place to be in right now. From the mainstream insurers, your capacity providers, how do they see this product? I mean, I think insurance moves, lags behind the market. Generally, they're quite slow to move, especially the large capacity providers, reinsurers. What's been the sort of reaction that you've got? You're a Lloyd's cover holder. You've got some capacity backing you. What's been the sort of reaction of the capacity providers?
We were delighted to join the Lloyd's Lab in April of last year, and that was really a catalyst for our engagement with the Lloyd's market and the capacity providers there. This was a wonderful program, and I seriously mean that. And it exposed us to all the syndicates and how the market was thinking about generative AI risk. And so I cannot commend that solution, that innovation, and the program that we went through any higher than, and the experience we had was exemplary. So that really opened up the door to bring our data, our technology to the syndicates and say, look, we've got a better grip on this exposure than anyone else in the market. We understand the real world liability risk, and we were seeking to cover, obviously, the areas of coverage that I mentioned. We actually came out with twice the coverage, twice the capacity that we were expecting in terms of dollar amounts, and we have significant appetite from other syndicates to join and join our binder. So I think at the moment we were very impressed with how forward thinking the Lloyd's syndicates were, especially our partners Apollo, Atrium, QB, and Hiscox. A brilliant panel of 4 providing us, with the most amount of AI insurance capacity on the planet to write what we believe is, the best in class risk. And I think they are very clear that they want a specialist in the loop here. We have full delegated underwriting authority to write this risk, and they really trust us because of the relationships we've built and are good stewards of that capacity. They know it's innovation underwriting. They know this is a new market. They have all joined us on a partnership to go on a journey over the next decade as to where the AI insurance market goes. And I know that they're pragmatic and we're pragmatic, and we value those relationships massively. But the Lloyd's capacity, the Lloyd's market, the brand, and the quality of the individuals who've been supporting us on the C-suite level has been brilliant. And we're very excited to be working with Lloyd's, which gives us global licenses. So if we wanted to open up or start our kind of insurance business in Singapore or Hong Kong, that would be no problem.
So what's the market like? Is there a lot of competition? Do you see some of the larger insurers getting into AI risk or covering AI risk?
We don't see that at this early stage. A couple of people are talking about doing AI insurance, but there's a difference between talking about it and doing it. We are the first insurance product that most brokers have ever heard of when it comes to generative AI, and the first to be onboarded at the major wholesalers as well. So I think we're in a great position. We're doing the work in behind the scenes, and we're just focused on building a portfolio of business and continuing to help companies innovate, adopt AI, and transfer the risk of doing so.
You do liability products right now. I mean, what else could you do? I mean, to expand the range of products that you have.
Absolutely. So we've started on third party because that's where we see the most litigation, and that's where we started on our data. First party is obviously coming up soon for us. And I think, we're very excited about other areas of the economy as well, such as robotics that I mentioned, or agents, we're already covering that. And I think in the future, the opportunity to do self-driving, autonomy, and more broadly data centers and infrastructure is going to be exciting for us. So we ultimately want to ensure the entire AI economy, and our expertise and the data that we're building now, being early in this market, will only contribute to our moat as we continue going forward and working on those different areas.
One last question I have is, we talk about the multiple vendors and the different AI solutions out there. Is there a product liability angle to AI risks? I mean, are these companies that are providing these tools in any way liable to some of these risks?
So our analysis currently is Testudo is doing a great job of covering an AI vendor selling their technology product or service to a third party. So it's software, it's technology. We think that's well covered under Testudo until it's not. But ultimately, the view that we get from the market is that Testudo is covering this. Regular E&O for professional liability, such as law firms, there are exclusions there now. So our coverage area can slot into that. As I said, it's modular. And so on the professional lines and the GL lines, that's where we are really playing at this moment. Vendors are obviously an appetite for us in the short term, and we'll have some announcements to come shortly on all of that. But at this early point, the liability exposure based on our forensic technical analysis sits with the deployers. And that is a big market. Every company basically in any industry, including technology companies, deploying AI. And that's what's in appetite for us and what we're focusing on underwriting. I'd say the other thing on the vendors that is not clear is that the base model providers keep eating swathes and swathes of vendors. It's not clear to me in the medium term or the long term which legal AI startup is going to win, for example. Claude has just announced a legal add-on. Anthropic, the same, is really, obviously Anthropic is Claude, but as these base model providers are rolling out more and more legal specific products, it's not clear which of these vendors is going to be a long-term winner when the fundamental technologies are so high performance and improving all the time. That's why, again, deployers are where we're focused, because those companies using AI are not going anywhere.
Finally, I mean, from Testudo, can you write risk from around the world, or you're in the US now because you Lloyd's paper? Do you write risk from around the world?
So we're getting submissions from around the world, including from Singapore. We don't currently have the Lloyd's approval to do that. However, Mithun, if you're sending me some deals, I can get that turned around pretty quickly with our capacity providers, and we'd be delighted to be working with brokers in Singapore and Asia to transfer that risk. It's with our Lloyd's cover holder status, not an issue for us to turn those licenses on. So as we see different pockets explode or come up and brokers sending us more deals, it's a conversation with the corporation, and it's a conversation with our capacity providers to walk into new markets, which Lloyd's will really help us to do.
Great. George, thank you very much. It was a fascinating conversation, and wish you all the best with Testudo. It was a pleasure. Thank you very much.
Yeah, thanks very much.
That's all from us in this episode of Between the Lines. We'll be back again in 2 weeks. In the meantime, you can connect with us on LinkedIn. Make sure you're subscribed to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.